We were told owning a home was the dream. A lawn to mow, a key that fits, a future built brick by brick. But somewhere the dream changed. Now it's not about the white picket fence, it's about surviving the spreadsheet. Rates have dropped, hope has risen, but let me ask you something. If money is cheaper, why does everything feel more expensive? Westpac Chief Economist Kelly Eckhold returns, a man who doesn't deal in dreams but in data. And the data's got a story to tell.
Financial freedom faster. Financial freedom faster.
Welcome to the New Zealand Housing Reset. Let's find out what's rising. Is it just another illusion? If you like making money rather than watching everyone else do it, hit that subscribe button because the numbers don't lie. More investors are getting the New Zealand housing and real estate intel from this show than any other YouTube channel in 2025. Kelly, rates are falling, yet affordability feels worse. What's the invisible cost we're not being told about?
Well, I mean, there's considerable extra costs coming through to investors in the form of local authority charges, rates, and to some extent insurance as well. So that's why, from the perspective of many households and investors for that matter, there is this perception that kind of costs are quite high. We see this reflected in business surveys where a lot of businesses say that they've got a lot of cost pressure and they'd like to try to push their prices up if they can. It's very prominent in the government-related areas where there's just a plethora of increased charges coming through to people, whether it be your rates or your water fees, driver's license fees, vehicle licensing fees, all of these things that in an environment where wage inflation is not very strong right now, it's just a impediment to making people feel that they're gaining.
Yeah, and this rate cut lifeline that's come through from the RBNZ, is this a lifeline for us, or is this just a sedative before that next punch that comes through?
Well, I think the Reserve Bank is signalling they're getting pretty close to the end here, unless something bad happens. So, one of the things that we learned last week when they gave the last rate change was that they cut the rate as expected. There's a few more questions around whether they all agree that rates should be cut, and quite a lot more questions about what happens next. Increasing signs that the Reserve Bank is going to slow its roll here a bit, not cut every meeting, maybe only cut one more time this year, and potentially preserve their ammunition in case some darker scenarios emerge for the economy.
And how long can this housing market pretend to be affordable just because the interest rates are going down?
Well, I mean, the period of sharply falling interest rates, I think, is probably behind us now. Interest rates have fallen a long way since August last year. The Reserve Bank has slowed down the size of the cuts, so it's only 25 basis points a time now, instead of the 50s that we were getting before. Financial markets are kind of like way ahead of this. They're basically priced in the end of the easing cycle to occur at some stage later this year, where the big arguments are really just about whether the OCR finishes up at 3% or 2.75%. So, from the perspective of ordinary borrowers, probably means that mortgage rates are getting fairly close to where they might end up. I won't say that it could be the absolute bottom because there's a bit of competition out there in the sector at the moment, so we might get some slightly sharper rates. But unless something really bad happens, it's probably not going to go a lot lower from here.
Yeah, I saw ANZ's released a very sharp 18-month rate, 4.89%, so hopefully the other banks come to the party. I saw your latest report with Cotality, a first-home buyers report. Auckland first-home buyers, average age getting up to 37 years old. Is this the renter generation living with mum and dad forever, or what's going on?
Well, there certainly is an element of that, isn't it? Like where first home buyers are having to save those extra few years before they get enough together to get the deposit to be able to put down on a new home. I think that's definitely the case. It's a sign of the times, given that prices ran up quite a long way in the last 20, 30 years. And obviously through that COVID period, there was a big run up, which has been arrested and reversed to some extent in some parts of the country, but there are other parts of the country where that's not really the case at all. So people are having to save a bit more. It also might be a bit of a sign of the times as well, because I think that people have delayed a lot of things in their lives, the sort of things that perhaps 20 years ago, 30 years ago, people might have done in their 20s, like getting married, starting to have kids and things, tending to kind of get pushed into the 30s as other priorities dictate. And I think we see that in home ownership as well.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart and subscribe. And what happens if inflation goes against expectations? Is the RBNZ going to reverse back on decisions or double down?
Well, I don't think the Reserve Bank is really looking at putting rates up at any stage soon. So I think that should be a real relief to housing investors, first home buyers. I mean, the issue here is really just about how much further might rates go down and how long will they stay down here. And our forecast would be that you've probably got a good year in the tin before you have to worry seriously about interest rates going up. So I think that's probably a good news story in that perspective.
And have you seen that coming through in the household and consumer spending data?
In the spending data, it's been a bit more mixed in recent months. We had a bit of a run up in spending in the first bit of the year, and a couple of weeks ago, we got retail sales data for the first quarter, the sort of formal data that goes into GDP, and that showed that retail spending had actually picked up a bit through that period. Interesting thing to note is things like car purchases had increased a bit, which is possibly a good sign, given that buying a new car is a big ticket purchase. Possibly something you think about when you're getting a house as well, potentially. In the last couple of months, it's just slackened off a bit. And I think it's probably reasonable to say that with all of these scary stories on the TV, people hear about trade wars, Donald Trump doing things, reductions in global economic forecasts, whether at the margin, some people might have just decided to put the wallet back into the pocket just to see what happens.
So should buyers be locking in now and getting like bang for the buck? Interest rate 5% or under seems pretty good.
Yeah, and I would be remiss if I didn't recommend Westpac's market-leading 3-year rate as well, which is under 5%. So
Well,
if
good
you're
on you,
interested
Kelly.
in security, well, then that's a pretty good rate.
Yeah. Yeah.
But, with respect to whether you lock it or not, I mean, when the Reserve Bank says they're close to the cycle, and I must admit, one of the Reserve Bank officials, the assistant governor, did suggest that she expected households to kind of like fix for a bit longer, looking forward, given the state of the cycle we're in. That is a sensible thing to think about. It's always possible that rates could go a bit lower from here in the mortgage markets. And, when I've had conversations with customers, large group presentations, I have heard the view that a lot of people think that maybe mortgage rates will get a bit close to 4.5%, which is possible. My point, though, is that if they were to go much lower than that, that would probably be associated with a much more negative economic environment. Probably one where the unemployment rate is going up quite a bit, and that's unlikely to be a happy scenario for anybody, really.
And do you think that that's what had impacted the split vote? The Monetary Policy Committees, whoever was that dissenting voter, were they looking at the job growth or the job seeker numbers, or what do you think they were looking at to say, hey, we don't need another rate cut?
I think there were a few of them that had the same sort of idea, but perhaps there was just the one of them that decided to vote against the cut. And the issue there, I think, is that they're looking at the quite significant amount of easing they've done already in quite fast order. So they've eased as much and as quickly as they normally do during a period of economic crisis. And we don't really have an economic crisis going on here right now. So from that perspective, I think a few of them on the committee would just like to take a bit of a cup of tea and see what impact they're going to get out of the significant amount of work already done. But on the other side, there are others looking at that global environment worrying that global trading partner growth will slow quite a bit. This great run in commodity prices that we've had in the last 9 months to a year could just go backwards a bit. So that kind of key support might just weaken a little bit. And the possibility there that could really just delay the recovery in the economy and mean that lower interest rates might be required.
Well, there is a lot of global trade friction, and now Elon and Trump are fighting quite publicly. Is this the time where we say, look, we can't rely on the rest of the world and we've got to double down on investment in New Zealand, the business investment side of things and infrastructure? Like, well, what's the information you're looking at showing you?
Yeah, well, I think it is certainly that stage of the cycle where businesses will need to start be thinking about setting themselves up for the next few years. And if we look in the budget, the really positive thing that came out of the budget was this new investment boost policy, which allows firms that choose to invest in new physical assets and plant and machinery to be able to depreciate an extra 20% in the first year of the investment. So that's a nice little tax discount available there. And I think there will be sectors of the economy that will look to take advantage of that, particularly those parts of the economy that are already seeing better income flows. And you can't look much further than the farming sector and the external sector, and potentially even parts of the property sector for those sorts of opportunities.
Well, the New Zealand dollar has been gaining strength. What are the costs associated with a stronger New Zealand dollar? And is it just because the US dollar has been so volatile? No. How should we be thinking about this?
Largely, the New Zealand dollar is rising because the US dollar is continuing to drift off. And the US dollar is drifting off because of all of these ructions that are going on in Washington, D.C. at the moment. It's coming down, but also because the US dollar is probably still a bit overvalued, so it could stand a bit of a fall to kind of get back to more normal levels. And obviously, there's a lot of debate and concern about the US fiscal position and whether this big, beautiful bill that Trump is getting through Congress over there might meaningfully increase the size of the fiscal deficit in the US, increase the debt to GDP ratio to kind of eye-watering levels that perhaps investors might not be that keen on continuing to support.
It's an American philosophy that things can be big and beautiful, I guess. Now, New Zealand 2025, bit of a reset. Who is going to get the most advantage out of this? Because construction activity is still down. Is it going to be consumers that win because prices ease back, or is it going to be banks that win?
Well, I think the winners this year is actually the agricultural sector and anybody out there in the regions that is close to that. We're already seeing that to large part because house prices, property prices out there in the regions are performing much more strongly than they are in Auckland and certainly Wellington. Unfortunately, if you've got a business that is particularly tied to government spending or activity by the government, then you're having a really tough time. The construction sector is really just in the bottoming out phase now of the cycle. So it's still pretty tough for them. And realistically, it's kind of like a later this year story before they start to see meaningful respite. Although I will say that in the first quarter GDP data, we were pleasantly surprised. The volume of work put in place that goes into GDP was flat for the quarter. We thought it would have fallen. And that reflected stronger residential construction, but also a weaker non-residential construction, which is that kind of infrastructure pipeline, which is a bit clogged right now because the government hasn't made decisions.
Well, I appreciate your insights today, Kelly. And if you want to take advantage of that 3-year Westpac rate, you can talk to us and we'll help you lock it in. And look forward to talking to you again, Kelly.
Pleasure.
A final reminder, money moves fast and the investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, just know that someone else is already using this knowledge to make their next deal while you hesitate.